Let's talk about your mortgage loan payment. You may still have that great below 4% interest rate if you financed prior to 2021, but who are you paying every month? Has it changed? Maybe even several times since you started your mortgage? Pull out your mortgage loan and escrow statements, put on your thinking cap, and let's take a look at some things.
Following its acquisition of Mr. Cooper, Rocket Mortgage is now one of the largest mortgage servicers in the U.S., handling about 16.7% of all mortgages. Did they start sending your statements? Other major mortgage servicing companies include JP Morgan Chase Services over $8.7 trillion, Wells Fargo Services over $6.6 trillion in mortgages, U.S. Bank Services approximately $3.2 trillion, Truist Bank Services around $3.5 trillion, PNC Bank Services about $3.5 trillion. Additionally, specialized servicers like Freedom Mortgage, mpamag, and Mr. Cooper, all bought by Rocket, are major players, particularly in government-backed loans like FHA, VA, and USDA. What is that cushion amount in your escrow account? Do servicing companies get paid interest on the cushion funds of yours they hold in escrow? Yes, mortgage servicers like Rocket Mortgage typically invest the funds held in escrow accounts, but borrowers rarely earn interest on these balances. Federal regulations set some limits on how much can be held, but do not require lenders to pay interest to mortgage payers on escrow funds. However, 14 states, including California, New York, Maine, Vermont, Alaska, Maryland, Minnesota, New Hampshire, Oregon, Rhode Island, Utah, Connecticut, Iowa, and Massachusetts mandate that servicers not controlled or selected by the account holders pay interest to borrowers. The rates and rules vary by state. In most other states, servicers or their banks may earn interest or investment returns on pooled escrow funds, but those gains are not passed on to homeowners. I notice Ohio is not on this list. The experts cite that escrow accounts are primarily designed as budgeting tools, not savings accounts, ensuring timely payment of property taxes and insurance. But those budgeting tools are certainly profitable for the loan servicing companies. Are profits required to be disclosed on annual reports from Rocket Mortgage? Rocket Mortgage's annual reports do not disclose profits specifically earned from investing escrow funds. While servicers typically invest escrow balances, the company's SEC filings focus on major revenue streams like gain on sale of loans, servicing fee income, and interest income from lending activities, not investment returns on escrow accounts. Why is it not federal law that these large mortgage servicing companies are not required to disclose profits or pay interest to account holders for this cushion money? Are you being charged monthly for an anticipated escrow shortage due to rising property taxes and homeowners insurance? Think of the billions these servicing companies that you did not select are collecting as interest from your money being taken little by little from your mortgage payment. Even 2% back, like is in place in New York, could help you not have an escrow shortage in the future. Instead, it results in huge profits for these large mortgage servicing companies. So take a look at the cushion amount in your escrow statement. It could be anywhere from $1,200 up to over $3,000. Have you looked at the breakdown on your monthly payment? Many are now stating their escrow amounts have now bypassed the principal and interest part of their payment. Most don't look at their statement, it's just drafted automatically every month to pay the mortgage. It seems this system needs reform to benefit the consumer, but unfortunately will not get attention on a national level due to the backlog and overload of issues facing lawmakers in Washington, D.C. I hope this information was helpful for you. Thanks so much for watching. See you next time.